Be Wealthy and Smart, episode 540.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, since it is tax season still, I saw this article and I thought of you and thought this would be something good for us to talk about. It's 7 things that could trigger an IRS audit of your taxes. Well, we all know everyone wants to avoid getting an IRS audit. That's the last thing any of us want to deal with. It takes a year out of your life and it's super scary. So let's avoid those things that might be sending a message to the IRS that they have to look into your taxes. And that's what we're going to do today. I'm going to share with you those 7 things that might trigger an IRS audit if the IRS saw these on your taxes. This article comes to us from Yahoo Finance and was originally posted on USA Today. Doesn't tell us who the original author was, however. And it says, no one wants a visit from the IRS, but if you get too generous with your calculations, you may need to back up your tax return. For individuals, it usually comes down to being too overly aggressive with tax deductions or benefits that could invite the IRS in, says Logan Alec, a certified public accountant and owner of the personal finance site Money Done Right. In most cases, you'll receive a request for more information if your return falls under review. In tax year 2017, 7 in 10 of the agency's return examinations were conducted by correspondence rather than in person. So I just want to pause right there and say this is a current March 19th, 2019 article. It's just that looking back at the tax returns that did have some interest by the IRS, most of that was done over email rather than having them show up at your doorstep and doing it in person, thank goodness. So 7 in 10 were conducted by correspondence. It goes on to say, still, if you receive a notice from the IRS, take it seriously. Respond quickly with the documentation that the agency requests, such as letters from charities or bank statements. Yes, that's definitely something you want to do. Now, I have a CPA, and my CPA is always looking for ways to keep us out of trouble and not being too aggressive with deductions and things like that. She's very, very conservative. And that's one way that you can sort of stay out of that red flag area. But if you do get a letter, if they have any question at all, you want to be super quick to be responding to them, give them full documentation, receipts, all the information that they want. The article goes on to say, if you're not responding or not giving what the IRS feels is adequate documentation, then it could become a full-fledged audit, Alex says. Here's what could trigger an audit or review. The first thing is too high deductions. Certain deductions you take can't be fudged without raising some eyebrows at the IRS. For instance, the IRS receives information on the mortgage interest you paid, so you can't inflate that figure. Others, such as charitable contributions, are easier to overstate since the IRS doesn't get documentation from charities on your donations. But the agency does use statistical algorithms to make sure the deductions you claim are in line with your total income. If they're too high, the IRS may request documentation to back up your claims. The second thing is missing income. If you're tempted to forget to include income from a side gig or contract work, don't. The IRS receives copies of your W-2 and 1099 forms from companies you worked for. It will match the information it has against your tax return. If that data doesn't line up, your return will be flagged for review. I just want to pause there and say, yes, absolutely, they get a copy of any W-2s or 1099s so they know exactly what you should be claiming. And if they don't see you claiming that income, then they're going to come after you and contact you and ask why you didn't mention that income. Number 3, you have foreign accounts. If you have a foreign financial account, such as a bank account, brokerage, or mutual fund, you may need to report it to the IRS when you file your taxes. For single taxpayers, you must file Form 8938 if the total value of your foreign assets is more than $50,000 or $100,000 for joint filers on the last day of the tax year, or more than $75,000 or $150,000 for joint filers at any point during the tax year. If you fail to do this, you could be fined $10,000. If you don't file within 90 days after the IRS sends you a notice, you can be assessed an additional $10,000 for each 30-day delay, up to $50,000. So I want to pause there and say these are for foreign financial accounts. As I said, bank account, brokerage, or mutual fund. If you're single and the total of your foreign assets is more than $50,000, or if you file jointly, $100,000 on the last day of the tax year, or more than $75,000 if you're single, or $150,000 for joint filers on any day at any point during the tax year, then you have to file Form 8938. And as it said, if you don't file it, that's a $10,000 fine. If they contact you and you don't file it within 90 days, they can fine you an additional $10,000 for each 30 days that you are delayed, up to a total of $50,000. So that is quite a steep penalty. You want to be aware of those foreign financial accounts that you have. And obviously, if it's below $50,000, you don't have to file Form 8938. But if you are above the limits that I mentioned, then you do have to file that form. The fourth thing that could cause a red flag is earning a lot of money. Simply earning a lot of money can be a red flag for an audit, Alex says. For instance, the IRS examined 0.5% of all individual returns for the 2017 tax year. The examination rate increased to 0.8% for non-business filers reporting $200,000 to $999,999 in income, and 4.4% for individual returns with $1 million or more in income. Once you cross that $1 million income threshold, your tax return is more complex, Alex says. There are more places for the IRS to poke holes in. So I want to pause there and just say, if you're earning between $200,000 to just under $1 million, 0.8% of people were examined by the IRS. And if you were earning over $1 million, 4.4% were examined by the IRS. So the more income you make, the more the IRS wants to know about it and wants to take a little peek at your tax returns and find more information. Number 5. Inflated business expenses. There is much wiggle room when it comes to reporting business income and deductions on Schedule C, so it can be easy to misstate or inflate information to your benefit. This is what the IRS looks for. Number 1, claiming more deductions than profits. Number 2, reporting round numbers for income and expense values. Number 3, reporting a business loss for too many consecutive years. Number 4, writing off 100% of an item as a business expense that is often used personally, such as a car or cell phone. The IRS scrutinizes cash businesses such as taxis, bars, hair salons, and restaurants, along with those in the sharing gig economy like Uber or Lyft drivers, says Mark Jagger, Director of Tax Development at TaxAct, a tax preparation software company. If the IRS has reason to believe you aren't being truthful, they will start questioning things, he says. So again, that was about inflated business expenses. Number 6 is wrongly claiming a child. If you don't file taxes with your child's other parent, you both can't claim the child as a dependent. This also can become confusing if a grandparent or other relative lives with or helps support the child. While this is usually an honest mistake, it could still trigger an IRS review or letter if the same dependent is claimed twice. Yes, so if you are divorced, sharing custody of a child, just be clear who is going to claim them as the dependent. It goes on to say, generally the child must be younger than 19 and live with you for more than 6 months of the year. There are exceptions for older children who are full-time students. For divorced parents, use the tiebreaker rules found in IRS Publication 501 to figure out who can claim the child. And number 7, rental losses. There are special rules that allow you to deduct rental real estate losses against your regular income. First, you can deduct up to $25,000 in losses if you actively participate in the renting of your property. That phases out if your income exceeds $100,000 and vanishes when it reaches $150,000. You can still write off these losses if you are considered a real estate professional, someone who spends more than half of their working time and 750 hours a year in real estate. If you claim yourself as a real estate pro, the IRS could take a microscope to your return, Alex says. Make sure to document the hours you spend on your real estate business in case you're fingered for a review. End of article. So that's a good thing to remember, that you have to be active in your real estate management. And if you're actively participating in the rental of your property, you can deduct up to $25,000 in losses, and that phases out if your income exceeds $100,000. And when you get to $150,000, you can't write off any losses. But you could still write off those losses if you're considered a real estate professional and spend more than half your working time and 750 hours a year in real estate. So make sure that you can document and prove that you're spending those hours in real estate in case you're ever questioned about it. It's a good idea maybe to have a separate day timer or online calendar that you can record your hours on, and just keep track of the hours you're spending, because trying to go back and document that if you were ever questioned about it is a lot harder than if you can just get in the habit of documenting it quickly each time you're working on a project. So we'll just quickly review those 7 things again that could cause the IRS to audit your taxes. Number 1 was too high deductions. Number 2 is missing income. Number 3 is you have foreign accounts. Number 4 is earning a lot of money. Number 5 is inflated business expenses. Number 6 is wrongly claiming a child. And number 7 is rental losses. So just be very careful to stay clear of all of those things that we talked about, and hopefully you won't hear a peep from the IRS. If you haven't yet subscribed to Be Wealthy and Smart, please hit the subscribe button and tell your friends about the show. I love it when I hear that you're telling your spouse, your friends, your neighbors, your relatives about the show and sharing it with them. I really appreciate that. And the Wealth Heiress book is back in stock on Amazon. Ladies are loving it, but men are loving it too. Because don't forget, just like on this podcast, financial information doesn't have a gender. It's just the examples that I give that have a gender. But how to build wealth, the 6 steps to wealth, creating your millionaire action plan, your map, and your Wealth Heiress checklist, all of those things apply to you guys too. And read some of those reviews from the men. They are really loving the book and find it extremely helpful. So guys, be a hero. Buy it for yourself, read it, and then pass it off to a lady in your life. And don't forget, we have our review contest going on for a little bit longer this month. You have one of 25 prizes that you can win, and your chances of winning are really good. You can win 11 Wealthy Mindset Blueprint audio sets valued at $197, 11 of my Wealth Heiress books, personalized by me, and 3 wealth mentoring sessions valued at $500. All you need to do is leave a podcast review on iTunes. That gets your name in the drawing 5 times. Leave a book review on Amazon. That gets your name in the drawing 7 times. And if you do both, your name is in the drawing 10 times. I'll be announcing the winners on the first podcast in April. So tune in and make sure and find out if you've won. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.